As you go through life and maybe do some video recording of some, might be an assignment or a podcast, word to the wise, remember to hit record because I just did half of this tutorial basically speaking to myself and the wonderful colleague that is currently beside me listening to me, and I didn't hit record. So let's try this. Take two. All right, so this corresponds with your note on receivables. We have assumed since the beginning of time that all of our customers are going to pay us. That is not the case in reality. Some customers simply don't have the means or maybe are unethical and they don't pay off their bills after we've sold them something. So let's look at a few methods. The first method is called the direct write-off method, and it is just that. It is super simple. So when we have an uncollectible accounts receivable, we are going to create a new expense item called a bad debts expense. And that recognizes that we're not collecting money from our customers as we had hoped. So the scenario I have in this tutorial, in this example, on the 7th of September, G Vespa's motorcycle company has an accounts receivable to J Bowlby that has been determined as uncollectible. It's for $5,000. So when we're using the direct write-off method, we simply just create a new expense, and we know expenses are plus minus accounts, so they increase with a debit. And that expense is going to be a bad debts expense. And then what we'll do is we're going to close that accounts receivable by crediting it for $5,000. So typically, in a typical transaction that we did in the past, it would have been debit to cash and credit to accounts receivable. In this case, J Bowlby has decided not to pay the bill, and we are going to just create a bad debt expense. So we don't need to spend any more time because that's how you do it. It's just a bad debt expense and an accounts receivable. If they end up coming back and paying it, we just reverse this entry and then do as we did before with cash and accounts receivable. Okay, let's go to something a little bit trickier called the allowance for doubtful accounts. And when we use the allowance method, there are two methods we are going to look at. One is we are going to look at the income statement and our revenue. So we're going to use a percentage of sales. And the other one is going to be a percentage of receivables using the balance sheet as our metric. So let's get into percentage of sales. And here's a typical scenario you will see. So Thomas Company uses percentage of sales to record bad debts. It estimates that 1% of net credit sales will be uncollectible. So credit sales are your sales minus any discounts and returns and allowances. In this case, we had sales of $1 million and then returns of 100, so net sales of $900,000. We also see that our allowance for doubtful accounts, which I'm going to talk about in a second, has a credit balance of $44,000. When we're using this percentage of sales in the income statement, that's a bit of a red herring. We're going to ignore allowance for doubtful accounts because that's a balance sheet account that I'll explain in just a moment. So to do the recording of our bad debts, what we do is we take our $1 million in sales minus our 100,000 in returns, and that gives us 900,000 times 1%. So our bad debt expense is going to be $9,000. We're going to debit it just as we did in our first example, but we're going to credit an account called allowance for doubtful accounts for $9,000 as well. So put that in your ear for just a sec, because we're going to talk about what allowance for doubtful accounts is as we look through the percentage of receivables. So the allowance for doubtful accounts account is a contra account, which means it is attached and it adds counter to our receivables. So it is directly tied to our receivables and it gives us our net realizable value. So if we have $1 million in accounts receivable and we believe that 100,000 will not be collected, our net realizable value is 900,000. So we really want to create this. We're allowed to estimate it just like we do with depreciation. And when we use our receivables as our estimate, we actually want to know what our allowance for doubtful accounts is. So here's our final scenario for the day, and there's two different scenarios we'll look at in this. So Henry Co. uses percentage of receivables, and they estimate that 4% of their total accounts will be uncollectible. Receivables are $1 million, and the allowance for doubtful accounts has a credit balance of $5,000. So a lot of info here, but let's look at it. If you were to take your calculator and take 4% of $1 million, it means that our allowance for doubtful accounts should have a balance of $40,000. In this scenario, it says the allowance has a credit balance of $5,000. So we know it should be 40, but it has 5. So I'm going to show you now. I'm going to take you over to a spreadsheet. And this is the scenario here. So this is what the balance should be, but it is showing right now as $5,000. So when we look at it on a T account, we know that in order to get to $40,000, we're going to need to do an adjustment here, because 5 plus 35 is 40. So we are going to credit allowance for doubtful accounts $35,000. So here's your scenario. Bad debt expense, when we do our calculation, is short $35,000. So we're going to do a bad debt expense of 35, and then an allowance for doubtful accounts of 35,000 as well. And that's going to balance out. We want that to be recognized because we're probably not going to collect that based on previous business transactions. In the second scenario, which is separate, we're going to assume now that we somehow have a debit balance of $1,000 in allowance for doubtful accounts. So this is scenario 2 that we are looking at. We know it should be this, but for some reason it's this. So what we need to do is we need to do an adjustment of 41 grand in this. And again, scenario 1 and scenario 2 are independent of each other. So we don't care what happened in scenario 1 because this is an entirely different scenario. So in order to get our balance of $40,000, which is what we want it to be, we need to do a credit entry for $41,000. And then your entry will be bad debt expense, allowance for doubtful accounts, $41,000 in each case. So there's a lot in that first note. Take a few days to understand it. I've thrown up an exercise as well for you to work through. So that is there for your learning, and good luck. Reach out if you have any questions.